Assalamualaikum and a very good day. So today I would like to show you the suggested solution for June 2019 question 3, investment property MFRS 140. So question 3A, Nazira Bahad owns a 10-story building. A portion of the building is used for rental and another portion is used for administrative purposes. Briefly explain the accounting treatment for the building in accordance with MFRS 140 IP. As you can see here, it mentioned to you that a portion of the building is used for rental and another portion is used for administrative purposes. It means that this building has dual purposes or dual usage, right? So, since there's no further statement stating that whether this portion can be sold or rented out separately or not, so this is how you're going to answer this question, alright? According to MFRS 140, the building can be classified according to the portion used, alright? So if the portion used as rental and as administrative could be sold separately, an entity accounts for the portion separately. That is, the portion held for rental and or for capital appreciation is treated as an IP, whilst the portion that is owner occupied, which is for the administrative purpose, is treated as property, plant and equipment as per MFRS 116 PPE. In Malaysia, it is usually possible for portions of buildings, such as by floors or levels, to be sold separately as strata titles can be made available. Next, B. Arena Textile Berhad is a local company which involves in Malaysian textile industry. On 1st July 2014, the company purchased a land and a building to be used in the business. The building was leased out under operating lease to an outside party at a monthly rental payment of 12,500. On the other hand, the company did not use the land. Hence, the land was still vacant and had undetermined future use. So land was still vacant and had undetermined future use. Alright? So next, Arena Textile Berhad applies the fair value model for its land. The building is depreciated on straight line method over 50 years monthly basis. The following is the information related to the land and the building. Alright, given the initial cost on 1st July 2014, fair value on 1st July 2016, and also fair value on 1st July 2018. Okay, the question 3B1 asks you about the gain or loss on change in the fair value. So let's look at for the year 2016. For the loss in changes in fair value of 50,000. So right. Alright, as you can see, the land is 1.1 million, right? On 1st July 1000, right? On 1st July 2014, the land is 1.1 million. Then you will compare with the fair value given on 1st July 2016, so 1.05 million. Then you will get your 50,000 loss on changes in the fair value, right? So next onwards, your land will be carried at the fair value of 1.05 million. Okay, next. So for 2018, there is a fair value gain on changes in the fair value of 250,000. How do you get 250,000? It is from the 1050 compared with the 1.3 million. So you will get 250,000. Right, journal entries for the cost model, right? Since your building is carried out if using cost model. So the journal entries involved is debit depreciation expense, credit accumulated depreciation. This is for the year ended 2016. All right. So 1.5 million, the cost of the building divided by the useful life of 50 years, so 30,000. Next, for the rental income, since your building has been rented out, right? So debit cash or bank, 12,500 is for monthly payment, so times 12, so 150,000. Alright, so 150,000. Credit SOPR rental income 150,000. Alright, next for 2018. For 2018, debit depreciation expense, credit accumulated depreciation, same as for 2016, 30,000. And also for the rental income, debit cash or bank, 12,500 times 12 should be 150,000. Credit SOPR rental income. So what if the building use fair value model? So if the building use fair value model, so of course you will have to take into consideration the changes in the fair value. For 2016, you will get the difference of 300,000. So debit investment property, credit SOPR, fair value gain on IP, since you got increase in the fair value, right? So next, the second journal entries is for the rental income, debit cash or bank, credit SOPR rental income 150,000. For same goes for 2018, you have to compare the fair value with the previous deemed carrying amount. This time around, you got loss on fair value, so debit SOPR fair value loss on IP 100,000. Credit investment property 100,000. The second journal entries is just the same for debit cash or bank for the rental income, credit SOPR rental income. So as you can see, note the difference between fair value model and cost model is that for fair value model, you have to take into consideration the fair value changes, right? As for cost model, you have to do the depreciation journal entries. Journal entries on depreciation expense. Right. So next, C. Nabati Yam Berhad is involved in the food processing industry. On 1st January 2016, Nabati Yam Berhad purchased a building at a cost of 4.5 million. And used it as an owner-occupied property with a useful life of 40 years. Starting from 1st January 2017, the building was used as an investment property, right? At a rental payment of 120,000 per annum, right? The fair value of the building on the 1st January 2017 was 4,582,500, right? So as you can see here in the first paragraph, it states to you that actually the first part or the first phase, you use that building for owner-occupied property. Means that the building initially acquired and classified as PPE, right? However, on 1st January 2017, Daniel started to reclassify the building into investment property. Okay, so the company adopts the fair value model to measure its IP and revaluation model to measure its PPE. Right, so alright, for June 2019, question 3C, the accounting treatment. On 1st January 2017, there was a transfer from owner-occupied property. It should be owner-occupied property P here, right? It should be P here. Right, owner-occupied property to investment property, because there was a change in use. Alright, so you have to mention the word transfer from owner occupied property to investment property, since there was a change in use. Okay. Next, the carrying amount of the building on this date was 4.387,500 million. Alright, so how do you get the carrying amount, the cost? You have to minus with the accumulated depreciation, which is 112,500. Okay, 112,500. You have to provide depreciation for how many years? You bought that building for 1st January 2016, so just 1 year. Okay, just 1 year. So your accumulated depreciation is you have to take the cost amount, which is 4.5 million, divided by 40 years. Alright. Okay, so you got the carrying amount of the building was 4,387,500. Right. Next, the accumulated depreciation of the building of 112,500 was to be eliminated. Right. Thus, there was a surplus or valuation of 195,000 to be credited to ARR, because you compare the carrying amount of 4,387,500 with the fair value on the date of transfer, right? So for this question, for the transfer part, you have to settle all the transaction involved while that building was still a PPE before you reclassify it to IP. So the deemed carrying value for the IP was for 582,500. So again, how did you get the value of surplus? You take the fair value on the date of transfer, which is 4,582,500, minus the carrying amount of 4,387,500. Then you will get the surplus or valuation of 195. Okay. So there will be no depreciation for IP onwards because it was measured based on the fair value model, right? So that's all for today. If you have question, you can always text me. Thank you very much for watching. I'll see you guys later.